A long-held belief has taken root in boardrooms, classrooms, and investment forums around the world. People ask with excitement, will India be the next China? That phrase echoes in strategy pitches and social media threads alike. At first glance, it sounds almost inevitable. After all, India is growing faster than most major economies. India overtook Japan in late 2025 to become the world's fourth largest economy by nominal GDP, reaching about $4.18 trillion. That is a milestone few could have predicted decades ago. Yet behind the excitement lies a deeper story. To tell it properly, we must go beyond slogans and dig into the facts. We will trace the remarkable rise of both nations, study the forces that shape their paths, and explore why, despite India's tremendous promise, it will never replicate China's unique economic ascent. China's rise was revolutionary. Over the past 4 decades, China transformed from a primarily agrarian economy into the world's second-largest economic power. In 2025, China's GDP was around $19 trillion, roughly 4 to 5 times larger than India's in nominal terms. Its manufacturing sector became the heart of its growth engine, supported by massive infrastructure investment, state-led planning, and a tightly coordinated workforce. China became the factory of the world, dominating electronics, machinery, and steel production on a scale unmatched by any other nation. The country's trade surplus reached almost $1.2 trillion in 2025, a record driven by exports to markets beyond the United States, even as tariffs rose. India, on the other hand, took a very different path. Its services sector leads growth, while manufacturing remains a smaller share of the economy. In 2025, India's manufacturing accounted for roughly 27% of GDP, compared with China's nearly 30%. India's domestic consumption and services-driven expansion have propelled rapid GDP growth, but its industrial base has yet to develop with the same intensity as China's did during its own boom years. Both nations share an extraordinary demographic advantage. India now has a younger population overall than China, with a median age near the late 20s, while China's workforce ages rapidly. India's working-age population is projected to grow from about 990 million in 2024 to over 1.13 billion by 2050. China's population is expected to shrink in coming decades, with its dependency ratio increasing sharply. From a distance, India looks like it might be poised to overtake China. But numbers alone do not tell the full story. To understand why India will not become the next China, we must explore the deeper structural differences that separate their economic models. India's growth rate has captured headlines. For 2026, economists have projected India's economy to grow around 6.2 to 6.5%. This growth rate places India among the fastest growing major economies in the world. And in the fiscal year 2025-26, Indian official estimates anticipated growth near 7.4%, driven by services and manufacturing expansion. China's growth is slowing in comparison. A Reuters poll of economists projected China's growth at around 4.5% in 2026, constrained by weak domestic consumption, a struggling property sector, and a broader structural shift toward slower growth. At a glance, this seems like a turning of the tables, yet growth rates alone do not determine economic power. The real story lies in the base from which that growth occurs. China's economy is simply so much larger that even slower growth rates add more in absolute terms to output than India's faster rates. In 2025, China's GDP added about $1.26 trillion to the global economy, a huge figure compared with India's $383 billion addition. If India sustained its higher growth for years, it could narrow the gap. But this is not the same as following China's path. China's rise was built on decades of consistent double-digit GDP expansion, above 10% in 15 different years since the early 1980s. India has yet to record a single year of double-digit growth that lasted beyond short bursts. Furthermore, China's GDP per capita remains far higher than India's. In 2025, China's GDP per person was around $13,087, compared with India's roughly $2,878. That gap reflects decades of productivity gains, high investment, export discipline, and industrial scaling that India has not matched. China's economy was built on an industrial foundation. That foundation was supported by investment rates that consistently reached up to 50% of GDP, compared with India's average of about 30%. China's vast ports, high-speed rail networks, and sprawling new cities created a logistical web that enabled manufacturers to produce at scale and export worldwide. India's infrastructure story is different. Investments have been rising, and programs like the government's infrastructure push have improved roads and logistics hubs. India has also benefited from digitization, with systems like UPI boosting financial inclusion. But the industrial footprint, the network of factories and export hubs, is not yet on the same scale. Production-linked incentive schemes have stimulated electronics and auto parts manufacturing growth, but India's global share of manufacturing remains modest by comparison. The automotive industry, for example, is the world's third largest by annual production value in India. But even in 2025, its value of about $250 billion lagged far behind China's $530 billion automotive output. And while India has room to grow, it still faces challenges in scaling the supply chains, logistics networks, and production clusters that enabled China's export surge. The difference is not only in size, but in coordination. China's economic model emphasized state-directed investment, massive infrastructure planning, and centralized execution. India's model is more decentralized and democratic, with private enterprise driving much of the growth. That can be an advantage for innovation and adaptability, but it also means growth often unfolds unevenly, sector by sector, rather than following one uniform industrial engine the way China's did. China's global trade footprint is enormous. In 2025, its export strength allowed it to build a trade surplus of $1.2 trillion, even in a period of rising global tariffs and geopolitical friction. That surplus reflects integrated supply chains that span continents and decades of foreign direct investment into China's industrial corridors. India's trade story is more nuanced. Exports are growing, and multinational firms are diversifying supply chains to include Indian production as part of China Plus One strategies. Many global corporations are investing in India's electronics, auto, and renewable energy sectors, attracted by domestic demand and competitive labor costs. These shifts are real and significant, but they represent diversification, not replication of the China model. China's domestic consumption has been slower to recover, and its property sector has faced prolonged weakness. Those are real structural challenges. Even so, China remains a dominant player in global trade networks, with supply chains deeply embedded across Asia, Europe, and Africa. India's consumption story is strong domestically, but less influential globally. India's middle class is expanding rapidly, but domestic consumption does not translate into export dominance in the same way China's industrial output did. To match China's global export footprint, India would need sustained, large-scale expansion in manufacturing capacity, supply chain integration, and infrastructure investment, combined with international trade agreements and export financing systems that rival those of East Asia's biggest economy. One area where India does hold a clear advantage is demographics. China's population is aging. Its workforce began shrinking after decades of falling birth rates and the long-term legacy of population controls. India's younger population and expanding labor force offer a demographic dividend that could fuel economic growth in the long run. Yet, demographic advantage alone is not enough. Productivity levels must improve. India's workforce needs access to better education, training, infrastructure, and capital. Without major gains in productivity, a growing workforce cannot achieve the economic transformation seen in China's heyday. China's demographic challenge now poses serious economic risks. But its earlier demographic advantage was harnessed during a period when global markets were open and eager for low-cost manufacturing hubs. India's demographic bonus arrives in a different era, an era marked by emerging protectionism, technological disruption, and shifting global trade ties. That means India must compete differently, not just scale what China once did. So, where does this leave us? India is a remarkable success story. Its rapid economic expansion, rising GDP rank, and youthful population set it apart as a global growth leader in the 21st century. For 2026, India is projected to grow faster than China and most major economies. Yet, the phrase "the next China" obscures more than it reveals. China's economic trajectory was shaped by unique historical, political, and structural factors. Its export-oriented industrial miracle was built on decades of disciplined investment, centralized planning, and integration into global supply chains. India's model emphasizes services, democratic institutions, digital innovation, and domestic demand. These pathways can deliver tremendous progress, but not a carbon copy of what China achieved. India's growth will benefit from its global partnerships and evolving role in supply chains. It will likely become a stronger manufacturing hub over time, and its internal market will drive global demand for decades. But India's future is not about becoming China. It is about becoming the best version of itself, a sovereign economic power with its own drivers of innovation, entrepreneurship, and development. The world does not need another China. What it needs is a strong, prosperous India charting its own story.